Hello, and welcome to On Air with Akin Gump. I'm your host, Jose Garriga. Cross-border mergers and acquisitions have been facing challenging times as recent political change and uncertainty, coupled with trade tensions, conspired to dampen enthusiasm and deter deal-making. However, these headline-worthy headwinds notwithstanding, cross-border M&A deal flow has remained resilient. In this episode, Akin Gump international competition and trade partner Davina Garrod and corporate partner Gavin Weir take a look at how Brexit, trade scuffles, and the 2020 U.S. elections are shaping the deal landscape, outline some of the paths that dealmakers have taken, or carved out, to get transactions done, and offer their outlook for M&A in the UK, Europe, and beyond. Welcome to the podcast. Davina, Gavin, thank you so much for appearing on the show today. This is a big topic, so let's dive right in, starting with a bit of background for listeners. Gavin, if you would, what is the current state of M&A in the UK and Europe, and how is it being shaped by Brexit?
Hi, Jose. First of all, thanks very much for having us on the podcast today. The UK M&A has seen a dip of about 10% in the last 2 or 3 years since the Brexit referendum. Interestingly, I think there's a view from many commentators that this is just a coincidence. It's not necessarily directly related to Brexit. The main driver for the uncertainty has been around a parliament which has been almost in paralysis because of a minority government, combined with economic uncertainty and a concern in some business circles about the prospect of a left-leaning Jeremy Corbyn government or indeed a hung parliament. So whilst it looks like Brexit or the prospect of Brexit was going to have an effect on the UK, actually my view is that what was really driving things was the uncertainty in the market. And with the outcome of the recent election in December last year, we now have a very strong government which happens to be very business friendly. So it looks like the direction of travel is towards some form of deal by the end of 2020 in one shape or another. And I think what most people appreciate is now having some certainty. Many of the commentators that we've spoken to have said that their biggest fear factor, if you like, was the prospect of a Jeremy Corbyn government. Now that that's gone away, interestingly, we've already seen in January and early February of this year a recovery in the UK housing market where there are some anecdotal messages about prices being up relatively dramatically in some parts of prime London, which is usually an indicator that wealthy investors are coming back into the market. So if that is true, then I think that could be a precursor for a recovery in the M&A market. And certainly we're seeing a backlog of deals that could have happened in late 2019 coming up the pipeline for 2020. Davina, are you saying the same thing?
Yeah, absolutely, Gavin. You've made some really good points. And, it's great that we have political stability at last now until May 2024 with a very pro-business government. So that's one piece of good news at least. And we're now in the UK in a Brexit transitional period, which means that we're effectively still in the EU from a regulatory perspective until year end. And in the meantime, Boris Johnson is pushing a divergence policy with the EU and aims to play off the EU against the US in trade negotiations later on this year. Now, it's not clear how this will play out, but what we do know for sure is that the sterling-dollar exchange rate has held below the long-term average for the last few years, making the UK a very attractive market for US acquirers in particular. Indeed, the private equity venture capital industry is sitting on cash reserves of approximately $1.45 trillion, which they need to deploy. And major recent American acquisitions of UK companies include a consortium of largely North American investors acquiring Inmarsat for £4.2 billion and Advent International's £4 billion purchase of Cobham.
Davina, it's interesting you're saying that about these US inbound deals into the UK, because one of the features that we've seen over the last few years in the European M&A market is that the UK historically always accounts for somewhere between 30 and 40% of all inbound transatlantic M&A from the USA. That has not changed in the last 3 years since the Brexit referendum, nor do we expect it to change. Interestingly, the statistics show that, although I mentioned earlier on that the UK suffered a dip in M&A over the last few years, well, so did France, Germany, Italy, Spain, and other major centres in Europe. That makes me think that any suggestion that there was a dip caused by Brexit, I don't think is right. And apart from anything else, it's too early to tell because Brexit hasn't really happened yet. Brexit's going to happen really in practical terms at the end of this year, 2020. although officially it happened on the 31st of January, there will be no real impact, in my view, during this year. And if anything, actually, for all the reasons you've just described, like foreign exchange, ironically, the Eurozone looks like it's dipping just as the UK is arguably going to be growing faster. I think there'll be more M&A and more opportunities for M&A in the UK with the new political stability than would otherwise have been the case.
Thank you. Thank you both. So let's talk then about some other issues that might be impinging on M&A and see what kind of impact you all think they might be having. Davina, if you would, economic protectionism, foreign direct investment controls, even climate change. Any impact on the deal-making environment?
Yeah, absolutely. I mean, Gavin's right about, a wider issue with M&A deal flows EU-wide, and I like numbers. So just looking at the stats here, EU M&A flows were down last year compared with 2018, so 883 billion euros to 1.08 trillion euros. And again, political instability in many countries, migration concerns from the Middle East and Africa, and the EU's own elections were key factors. Climate change, I think on the margin, now that addressing climate change has finally become a priority of the EU and is diverting management attention in the private sector. I think it's fair to say that heightened FDI screening and national security reviews are an expression of economic protectionism, no matter what the governments in question may say. And in Europe, we now have at least 15 member states reviewing foreign investments, often in sensitive industries such as defence, energy, technology and media, those sectors where we're seeing most growth in M&A inflows. I think the considerable uptick in Chinese FDI in particular in 2017 had sparked aggressive scrutiny by the French and the Germans, who together pushed for an EU-level screening regime, which entered into force last year. And the weaponisation of trade vis-à-vis the US and China had fuelled a rebalancing of Chinese money towards Europe. Just as Chinese investment fell in the US in 2017, it grew by 73% in the EU that year. And as a result, our acquirer investor clients now take into account FDI and national security reviews, as well as antitrust investigations, when negotiating deal structures and timetables.
Davina, I think that point you just made is actually really interesting, because whilst for some clients, I think those hurdles caused by geopolitical issues will cause them choose not to do M&A deals or to walk away from deals that are already on the table. I've seen some situations where some private equity clients have actually actively pursued situations because they've seen an opportunity in the M&A market where they believe that a deal might be perceived as less capable of being done and therefore is not attracting as many buyers. And the private equity buyers who are willing to spend time and energy finding a structure that works are actually, in their minds, getting a bargain because no one else is looking at it. So I think it's like everything. Where there's a challenge, there's also an opportunity. That's definitely a feature I think we'll see over the next year or two. Because the bottom line is, no matter what the difficulties caused by, say, short-term trade wars or short-term geopolitics or election cycles, M&A is made on much longer-term strategies, at least as regards corporates. Maybe not with private equity or funds. But I think some of the corporate clients we're speaking to are saying, actually, notwithstanding all of the media coverage and noise surrounding some of these issues, actually the long-term 5, 10, 15, 20-year plan, if an M&A deal is worth doing in particular circumstances, they're still going to do it, even if it's a bit more painful.
And then by the same token, I think the sell side has to do a lot more homework today when preparing an asset, including anticipating potential FDI and antitrust hurdles and preempting any buy-side concerns so as to attract the widest pool of potential buyers. Deals may take longer, but they will get done.
Thank you. So let's cross the Atlantic then and look at the extent that, if any, that the White House and the Trump administration's policies, particularly on trade and security, might be having to influence M&A, and to what extent perhaps U.S. elections here in 2020 might be affecting deal-making. Davina, what do you think about that?
So historically, Jose, M&A has been sluggish, as we know, in a US election year, given markets not liking uncertainty. However, I think digital transformation, increased activist activity, low interest rates, and the tremendous amount of dry powder sitting in the alternative investment space in particular will counter election cycle madness. And if Trump is re-elected, this will bode well for deal flow.
I agree with that, Davina. I mean, I think we're living through a remarkable cycle of deal making. I mean, the last year, there was a 10% increase in the volume of deals being done in the US in circumstances where around the rest of the world, deal activity was down. What's driving that? I think it's a combination of very, very business-friendly government in the US, the corporation tax cuts. And we've had 10 years of ongoing growth. Some people are beginning to ask, when is that going to end? People have been asking the same question for the last 5 years. And I think with a Trump re-election, if that happens, I think he'll try his very best to use the levers of government or policy to try and continue to be business friendly, and that will only bode well for M&A activity. Some people are beginning to say, well, is that necessarily a good thing? And whisper it quietly, but even M&A advisors at some stage think, is it boiling up a bit too much? Especially with all the trillions of dollars that you've mentioned, Davina, of dry powder out there waiting for deployment. But that said, I think that goes to the question of deal values and whether deals are too expensive. That's not really the topic of what we're here to discuss today. But I think as long as there's money to spend and as long as there's a benign environment to spend it, I think people will continue to do deals. I think the other factor that we need to bear in mind in the US is the possibility of Trump not winning the election. And none of us are crystal ball gazers, if you like. But, obviously the opinion polls are moving around a lot. And so one question people are asking is, what happens if Trump doesn't win? And if he doesn't win, who's it going to be? And how will that affect M&A? I think, personally, if the Joe Biden win, he's the candidate, then most people are saying his policies are less likely than others to have a major impact on M&A because he's more centrist than the other candidates. Having said that, I think an Elizabeth Warren victory or a Bernie Sanders victory, I think that really will make people sit up and listen. I think Elizabeth Warren in particular has indicated that she has some policies which are not at all friendly towards private equity investors in particular. Some ideas about taxing portfolio companies and taxing private equity fees. And I think for that reason, if it looks likely during the course of this year, there's going to be a Warren presidency, or even if she's on the ballot paper post the Democrat decision on who's going to be the candidate, then I think that might cause a little bit of pause amongst some investors. That said, I go back to my earlier comments. My view is I think people take a much, much longer term view on M&A than one single election cycle. Whatever happens, there might be a slight uptick or a slight downtick. But if an M&A deal is worth doing, people are just going to do it anyway.
Thank you. One other factor that I think has to be considered is the question of M&A deal flow to and from China in light of a variety of factors that have all made headlines in recent months, including the PRC's economic situation, most recently coronavirus, and certainly the ongoing unrest in Hong Kong. Gavin, what impact do you think that's going to have?
I think it could have quite a big impact, to be honest. I think if you'd asked me the question 4 weeks ago, before the coronavirus evolved, I would have said maybe a minimal impact. One thing to bear in mind is if you look at all the statistics from the last 10 years, there was a very, very, very dramatic increase in Chinese M&A into Europe and into the USA. That seemed to peak around 2016, 2017. And over the last 3 years, we've seen a downturn, as much as 50% downturn in volumes of inbound deals to Europe from China in the last 3 years. So you're talking about sort of coming off a relatively low base. So absent these events of this year, I would have been predicting a little bit of an uptick in China M&A into Europe and the US at least. Having said that, I think a combination now of the coronavirus, I think the China economic downturn, as we've noted before, Davina made some comments earlier about the scrutiny that many of these deals are getting from the EU and US authorities, trade wars, and now you add into that the coronavirus where people literally can't even get on a plane to negotiate deals. I think that has to have an impact, and how much is anyone's guess. One anecdote that we would give, we were speaking to a client a few days ago on this, that even down to practical things like the inability, for example, to get staffers in the Chinese regulatory bodies to actually get to work and approve deals that are already in the pipeline. So it could have an effect on people's long stop dates for their SBAs. It might have an impact on timetables, etc. It's leading to a lot of uncertainty. And I think in that environment, I don't see any other outcome than some form of downturn in Chinese M&A. And the only question is not whether there's a downturn, it's how dramatic it is.
No, absolutely, Gavin. And as it applies to outbound Chinese investments, particularly into the US, I mean, since Trump assumed president, It's been very, very difficult to get any kind of Chinese investment into the US. The Committee on Foreign Investments of the US has opposed Chinese investments, the last sort of 3 or 4 years, and even before that too. And even minority Chinese investments in European companies like the Portuguese energy incumbent EDP have been affected by CFIUS. Had China Three Gorges acquisition progressed, EDP would have needed to divest its US renewables business, for example. And notwithstanding Xi Jinping and Trump's signing of the Phase 1 trade deal, we still need to advise fund clients linked with Chinese money to ensure that the Chinese investment is made as passively as possible without Chinese control of the GP or the LPAC. And this is in strong contrast, for example, to the UK position, where the CMA and the UK government have approved all Chinese investments in recent years, from Gardner Aerospace and Sapura Hytera to Shigang Group, a global switch. And Boris Johnson's even green-lit Huawei's investment in the non-core elements of UK's 5G network, much to the chagrin of Donald Trump. Switching to inbound investment into China, there's no doubt that coronavirus has made for a dismal Lunar New Year in China for sure. And deal flow into China has been disrupted due to factory shutdowns and travel restrictions. Reportedly, Tesla's factory and others are due to restart production, but our Beijing colleagues are warning that the entire industry supply chain is still affected. And while staff at government agencies and state-owned enterprises are officially back to work, approving foreign investments is not a priority, unsurprisingly. Meanwhile, China-based employees at multinationals are working from home and dealing with chronic food shortages. I do think it's easy to over-dramatise the situation, though. We need to remember that SARS was contained and did very limited damage to the global economy, unlike the 1918 Spanish flu, which infected more than a quarter of the human population of the world.
It's interesting, your thoughts there, Davina, because I agree with you. I think we shouldn't over-dramatise it because it's still relatively early days. I think the biggest concern is the shutdown, effectively, of the country from overseas and internal travel, which I think will have a practical impact on deal-making. I wonder whether, in light of all of this, the irony of the situation is in the aftermath, might the Chinese authorities decide that they have to attract more inbound investment than they otherwise would have done, because they need to show that China's open for business. And they were already making moves in that direction by allowing more foreign ownership of private companies, where historically there was a limit on the stake that foreigners could own in Chinese companies. That had been removed anyway in some circumstances. Query, is that indicating more openness from the Chinese government anyway, and might they extend that in the aftermath of this year's sort of emergency, if you want to call it that? I think the other factor to deal with here is don't underestimate the long-term psychological impact of what's happening in Hong Kong to investors in China and people doing business with people in China. Again, we don't want to over-dramatise it, but query, might the situation there in Hong Kong combined with the coronavirus and other things lead people to look in other directions? For example, Singapore, New York and such like. Without wishing to go back too much towards Brexit, a lot of commentators are saying that actually the great winners from Brexit are not going to be other European cities. The biggest winners from Brexit potentially are going to be New York, Singapore and possibly Hong Kong. But I just wonder whether, in light of all of this, might there be a possibility that actually it's just Singapore and New York. That said, Hong Kong is remarkably resilient and will take a longer term view. So I think if anyone is going to turn the situation around, I would say the people of Hong Kong will do that. And as many people say, from adversity comes opportunity. And I would equally say that there could well be many opportunities to invest in Hong Kong and indeed in China after this, because as I mentioned earlier on, coming from a relatively low base over the last few years where there's been a bit of a downturn of M&A activity in Hong Kong and China, this might be a good opportunity to invest at the bottom of the market, if that's what it is.
That's absolutely right, Gavin. Never underestimate the ingenuity and resourcefulness of the Chinese, and in particular the Hong Kong Chinese. And indeed, the Chinese ambassador to the UK was speaking over the weekend, and he made the point that in Chinese, the word crisis means crisis and also opportunity.
Thank you, Davina. A reminder, listeners, we're here today with Akin Gump International Competition and Trade Partner Davina Garrod and Corporate Partner Gavin Weir, discussing the outlook for M&A in the UK, Europe, and beyond. All right, so let's turn now, having discussed a variety of the issues in the UK and Europe and also worldwide that could have an impact on M&A, to what I guess we could call news you can use. For listeners particularly, let's start off with a question that I'm sure a lot of people have, are what sectors are hot right now? And then which opportunities may be around the corner concerning M&A? Gavin, if you would, please.
Thanks, Jose. I think it wouldn't surprise anyone to know that the hottest sector remains the tech sector and has been for a number of years for obvious reasons. I don't see that changing at all. That said, I think the mix, if you like, within the tech sector is so broad that arguably the tech sector covers almost any industry nowadays, and we need to move on from that and come up with some subsectors. But I think anything involving data in particular is going to be very, very hot. I think, for example, healthcare historically has always been a big sector, but particularly healthcare data is increasingly popular, as is things like medtech. And I think that will provide M&A opportunities for healthcare companies. It also provides opportunities for tech companies themselves. And we've seen many examples of tech companies creating devices which on the face of it are consumer devices like watches or phones, etc., but actually they contain technology which actually helps you with your health and produces data that you and the company can use. So I think data is the big one. Other areas, energy, renewables, as some parts of the energy sector become less and less popular because of climate change and social policy, etc., that produces obviously opportunities in other areas like renewables. And I think we'll definitely see a lot more opportunities in the renewable space and anything that connects renewables to technology. Also financial services, I think that has always been up there in the top 5 sectors for M&A. I think that will continue to be the case. Interestingly, if you look at the statistics for China M&A over the last 10 years or so, there's been an enormous rise in the number of financial services deals done by Chinese buyers, both within China but also externally as well. So I think you'll definitely see financial services and in particular payments and fintech being big areas over the next year or two. The other big one is on ESG, where I think social change, views towards the climate, etc., that's got to be a factor in M&A decisions going forward. I can't believe that any large organisation or investor is not going to take that into account. It might not necessarily be a driver for an M&A deal, but it's definitely going to be a factor for doing an M&A deal.
No, absolutely. And in terms of a couple of other sectors too that have been popular over the last year or two, real estate and also aerospace and defence. And just to pick up on Gavin's points regarding data and life sciences, M&A activity globally in life sciences exceeded an unprecedented $357 billion last year, breaking the 2014 record. And that's partly down to 4 mega mergers: the AbbVie Allergan, Bristol Myers Celgene, Danaher Healthcare and Pfizer Mylan. The forces driving this activity will continue, I think, to push deals in 2020 as companies optimise portfolios to deepen therapeutic area focus, seek to increase near-term revenue and use novel deal structures to access innovation.
Thank you, Davina. And let's stay with you. So based on this preceding presentation by both you and Gavin, what are your predictions then for M&A in 2020 and 2021?
Yeah, I'm very bullish on European M&A activity throughout 2020 and into 2021, given the greater political stability in key markets, low-cost capital, a significant amount of undervalued assets, particularly in the UK, and all that private equity cash desperate to be put to work.
I would agree with that. I think I'm relatively bullish on European M&A, but I think particularly bullish on UK M&A. I think, Jose, the USA remains strong and will be strong despite election fever. I think Asia, is inevitable with the Chinese influence. I think will probably be down, but remains to be seen what happens across the rest of Asia. And then predictions for sectors, as I mentioned before, I think anything data related, I think is going to be hot. I think ESG will be a big factor. And I think the other thing we've not touched on yet, but I think is increasingly a factor in Europe, is the increase in activist-driven M&A. It might not be the major factor in a corporate board doing an M&A deal, but I think the activists are increasingly influential, either overtly when there's a sort of a public campaign, but actually what we're hearing is that there's a lot of stuff going on behind the scenes as well with the traditional activists and who are well known in the market, but also with some private investors who are maybe less well known, but who are agitating on the boards. And I think a lot of company directors I speak to are saying that they're increasingly mindful of that. And actually, in fairness, I think they're also saying that they, in some cases, welcome it because they realise that actually getting views from major shareholders and the outside world in a constructive way is very welcome.
Absolutely. And, some of more institutional asset manager type clients are becoming increasingly constructivist and suggestivist in their activities in this area. And conversely, some of the more activist type funds are sort of spreading their strategy, keeping with the activism, but also moving more into private equity as well. So we're seeing a number of kind of role shifts and a more amorphous approach to investment strategies.
Thank you both. So just to wrap up, a question I'm sure listeners will be having is, what short-term takeaways can you offer them regarding people, they're looking to make deals this year? What do they need to know?
Yeah, as we've said, there's a lot of undervalued opportunities in Europe and in particular in the UK, with relatively light regulatory scrutiny over here in the UK as well. Unless you're looking to acquire your major competitor in a concentrated market, that is, in which case the UK CMA will be investigating you in depth. In terms of other key takeaways, preparation and timing are key. Consult your lawyers early. And remember that the proposed UK FDI regime isn't due to kick in before 2021. And, the UK is very much open for business.
I agree, Davina. I think, I've mentioned before, I think elections, sanctions, trade wars and such, they make for good press. But in many cases, they don't stop M&A deals being done. So I think my takeaway is, yes, deals will be done. Process might be a bit more complex, a bit more time consuming. But if you plan early, consider your strategy to navigate around these issues, then you're more likely to have a good outcome. Bottom line is, be patient.
Everything comes to he or she who waits.
Listeners, you've been listening to Akin Gump International Competition and Trade Partner Davina Garrod and Corporate Partner Gavin Weir. Thank you both for appearing on the show today and taking our listeners on this terrific tour d'horizon of the M&A landscape. And thank you, listeners, as always, for your time and attention. Please make sure to subscribe to On Air with Akin Gump at your favorite podcast provider to ensure you do not miss an episode. We're on, among others, iTunes, SoundCloud, and Spotify. To find out more about the firm's thinking on European M&A, look for the publication Open for Business on akingump.com. And then to learn more about Akin Gump and the firm's work in and thinking on corporate, antitrust, and trade matters, look for international trade, antitrust, and corporate on the experience or insights and news sections on akingump.com. And take a moment to read Davina's and Gavin's bios on akingump.com. Until next time. On Air with Akin Gump is presented by Akin Gump and cannot be copied or rebroadcast without consent. The information provided is intended for a general audience and is not legal advice or a substitute for the advice of competent counsel. Prior results do not guarantee a similar outcome. The content reflects the personal views and opinions of the participants. No attorney-client relationship is being created by this podcast, and all rights are reserved.